Now, today we want to share more about who we are and then also the general market information, rental market trends, the regional sales and rental activities, and of course, about how you can get financing for real estate investments. Now, before I introduce the speakers, I do want to introduce myself first. My name is Helen Chong, and I have been in the real estate full time for almost 20 years now. And just a few months, I think it's around about May of 2025. And when I first started, I actually started as a loan officer, and then I also did some single family rehabs, and I started to invest in rental properties. And then I absolutely fell in love with multi-units investing because I realized that instead of investing in one single family house and then I have all these like roofs and repairs to do for each house, I can just buy a building, and then also the valuation and everything is very different. So through my own experience, started helping clients to buy their first home and then help them build their portfolio. Being a part of CCIM since 2014, and now I'm on the leadership board for the global CCIM community. Now we have a huge network with all the real estate professionals nationwide, including also Canada and Asia. So that's why we feel like we really want to really share with you our experience. Now, I built this company, Halen, in 2012, and it's been such an amazing journey. So our team is small, but they're absolutely mighty because every single one of our agents, they are just so skilled in what they do. We have residential agents, and then we also have commercial agents, and of course, we also have agents who specialize in working with real estate investors. Now, our team has done almost $900 million in sales volume so far, and we've been ranked top 1.5% top producing team nationwide in the last 5 years. So I'm very sure that if you're interested in real estate investing, our team absolutely can help you. So today, I'm so excited to introduce you guys to two of our agents who specialize in real estate investments, and they have helped so many of our clients to build their real estate portfolio. So let me just go ahead and turn this over to Alina Siert and Peter Whang.
Thanks, Helen. Hey, everyone. I'm Alina Siert. So just wanted to share a little bit about my journey in real estate. It began really young. So over half my life, I've been involved or devoted to real estate. I'm really passionate about helping others build wealth in this space because I'm on that journey myself. So my background includes, it's more unconventional, right? So I used to do loans at Bank of America when I was really young, but I ended up having a career in tech, which really firmed up finance analytics, program management skills. But then I also have a unique perspective because I've also ran my own businesses as an entrepreneur. So I have a really deep understanding in market dynamics and the consumer behavior. And so my expertise spans not only investment properties, but commercial transactions and also luxury real estate.
Hello, everyone. My name is Peter. I have been with Helen's team for, I think, about going on 8 years now, but been in the industry serving different roles for over 20 years. And what we are doing now is, again, helping new and seasoned investors expand their portfolio. So what we'll do today is go into a little bit more deep dive into a specific region, the beach cities of Southern California, and specifically the 2 to 4 unit market.
So before we dive in, I want to clarify something really important. I feel like it's an important takeaway for this session today. Investing in a single property alone rarely generates substantial wealth, right? Many assume it's easy to achieve cash flow and significant income from just one investment property. But success requires a strategic approach and really a team to guide you in building a well-rounded investment portfolio, whether it's in real estate or other asset classes. As Peter mentioned, we're double-clicking on SoCal. So why are Southern California beach cities such a hot spot for investments? We're going to share several reasons. So starting with the amazing year-round weather, this is an ideal place for both professionals and families. The shift to remote work has made these areas even more desirable, especially for people that work in tech. You may have heard the term Silicon Beach. Well, this refers to tech companies like Snap, which first set up their headquarters in Venice, followed by other major tech companies like Google and Amazon expanding to places like Santa Monica and Culver City. Although growth slowed during the pandemic, these areas remain hotspots with top-notch amenities nearby, easy access to both LAX and Long Beach airports. They're perfect for travel-conscious professionals. The beach cities along the Southern California coast have always been popular for work and play. However, it's really important to note that short-term rentals like Airbnb are largely restricted in these areas. So most cities have phased out nightly rentals due to lobbying from the hotel industry and concerns about neighborhoods turning into party zones. The restrictions actually improve the quality of life in these areas, which is great news for long-term investors. However, as property owners, it's crucial to monitor these regulations carefully, like rent caps, property registration, and inspections. Each city has different rules, so being informed is really key to maximizing your return on investment. So looking at the sales for the past 5 years for all of 1 to 4 unit properties in 3 of the beach cities in the region, Santa Monica, Long Beach, and Redondo Beach, you'll see the dips and peaks in a cycle, but overall it shows a gradual increase over a 5-year period, with fluctuations due to seasonality, activity, inventory, which really leaves the question, how would I know when to invest or sell? This illustrates the need to really partner and understand the real estate climate and help navigate these decisions. It is important to be knowledgeable of the current market conditions, historical trends, and this is also why we don't recommend short-term strategies based on speculation or market timing. It's important to be consistent and understanding the inventory to monitor what's going on. But as you can see, going back to the slide I was showing previously for the 3 beach cities, that you'll see a growth trend in Redondo Beach. And for Long Beach, it covers not only just the coastal region, but the entire city. So local regulations and ordinances can influence pricing for income properties, such as Santa Monica, which has rent control. In this overview here, specifically for multi-unit in these Southern California beach cities, it shows a historical perspective of an average of 30 to 45 days on market with an average price point of 2.5 million. So the peaks and valleys of the averages of a 4-year period really reiterates the importance of understanding the market conditions to help you determine when to buy and sell. So with that, I'm going to turn it over to Peter to talk more about market stats.
So thank you, Alina. Now we will dig into specifics for we're going to start at a broader view for LA County in general, so that you could understand some historical numbers, and then we'll start going more deep dive into this specific regions. The first chart that we'd like to go over is just kind of understanding the average rent growth throughout LA County. And this chart actually does not only the LA County local market rent growth, but also just kind of give you a basis of the US as a whole as well. As you can expect, the average pricing for LA is going to be much higher than the nationwide average, but some things to keep in mind here are just a gradual increase overall in how rents project from the past to the forecasting. Your average rent growth is dictated. Now, California has statewide rent control, but that is specific to certain caps in each city and county. What the thing to keep in mind for this is that with any type of rent increases, there's guidelines. But when you have turnover, meaning new tenants coming into place, that is when you could actually set market rates at that time. Probably the biggest eye-popping item to note here is this dip you see, and that corresponds directly with COVID. It was an unprecedented event that occurred in not only this country, but the world. And the real estate market experienced a traumatic incident through all sectors of the industry. Some are recovering, some are not. But specifically for rental units, you can see that even with the dip that occurred, there was a little bit of an overcompensation once everything started to settle down. We are now starting trending back to the averages. So when you see charts like this, you always want to look at anywhere from a 5 to 10 year projection and see what the averages are. So the growth you're looking at roughly at about a percent, around a percent a year, and the average pricing, you can see that it's lying anywhere from about 2,000 to 2,200 as an average. The next chart over here on the right specifies even further distinguishing between studios to 3 bedrooms. The line that you probably want to keep an eye on is the 2 bedroom rents. That's kind of a main metric that's used in the industry just to see. And again, this is consistent with this is the past 5 years and the growth, the gradual growth that occurs. Next slides, we will go through some another metric that's utilized in rental markets is your vacancy rates. This is again a broader LA County overview. And what you will also see here is that vacancy rates on average hover around 4 to 8%. That is the norm for most markets in the US. And when you dig deeper into the LA County markets, it sits a little bit lower. There's obvious factors in terms of population density, economics, etc., that dictates where these averages fall into. But the main thing to look at is that the vacancy rates for LA sit lower in the 3-star category. And let me actually add the 4-5-star category is related to newer construction, primarily newer construction. So anytime you have newer construction, you're always going to have a little bit higher uptick in vacancy rate. But averages always get into the historical zone. And by bedrooms, then you have, again, you want to keep an eye on that 2 bedroom zone, but studios will always have a higher vacancy count for various reasons. But number one, the inventory of it is much higher. And because studio units have a very specific set of a tenant pool. So historical trends will always show a higher vacancy rate for any type of studios versus 1, 2, 3 bedrooms. And now we will go into the specifics of reviewing the inventory for several of the SoCal beach cities. In this slide, we have the active inventory. These are all, as of September, all the active inventory for 2 to 4 units that we found to discuss for today. As you can see, Long Beach has a lot more active properties. A few items to point out here. And the reason why we've selected from 2 to 4 units is you need to understand the different metrics that come with investing in these types of properties. Even though, for instance, if we look at these 2 properties, you have two Long Beach properties. The asking price is about the same, around 1.7, but your current income, there's a pretty significant variance. So the reason why you have to always do extra due diligence is that you need to understand where these differences are coming from. At first glance, any investor would say, I definitely want the property that's generating higher income. But once you dig into it, then you'll start seeing different reasons. It might have long-term tenants who have lower rents historically, or there's even a vacant unit. So you can eliminate a large, sizable portion of the income. For these two examples here, that's exactly the case, is that this property has one vacant unit where this actually has both units occupied. And from there, you can also see kind of the different pricing ranges, even for Long Beach. And then once you start getting to some of the different cities, you see a pretty significant jump in the values. So that is active inventory, a broad view of the active inventory. Next, we'll actually get into some of the sales that occurred in these cities. This is again, we're going over very high level. We have a lot of data to digest. As mentioned earlier, we've allocated some time for Q&A. This is just to get a broad understanding, and then we will do the necessary follow-ups to start getting into any specifics at that time. So this again kind of shows you exactly the differences that are occurring even within the same city, as well as some of the different markets around different beach cities. Again, I'm going to highlight the couple of Long Beach ones just because of the significant variance that you see. This one, for obviously, is a completely vacant property. Now, we'll get into some of the specifics later, but for investors, it's important to understand whether or not you want to get a property that has a unit vacant or two versus one that has tenants in place. One of the primary reasons for considering a vacant unit is that you can, once the property is made ready, the likelihood of you achieving market rents becomes much faster. This one, I did not get into the specifics of exactly what this might actually be an error in the system, but there's no way that the gross income is $3,400. So these are the type of data points that we'll review, but this is again a high broad view of the type of sales that occurred. Now, the next slide we're going into is actually the rent rates. So if you recall from the previous slides of looking at the LA County higher overview, the 2 bedrooms were hovering around 22 to 2400. The reason why beach cities are unique and very favorable are the significant variances in the potential rent rates. So if you look here from anywhere from Long Beach to Manhattan Beach, any of these 2 unit properties, whereas the LA County averages sit in the $2,200-$2,400 range, you see the potential upside here. Now, you have to keep in mind that the location is a big play here, but also the property should be updated and has to provide certain amenities that warrant this type of increase. But these are active listings for rentals throughout various markets in the beach cities. So this alone shows you the price variance from an average LA County view versus beach cities. Next, we will start going into looking at a specific property once location is determined. Then we'll do an overview of how lenders look at these properties. And then for you, as the investor, we'll kind of do an overview for the income approach versus cash flow, which obviously everybody is very interested on what it looks like on a cash flow basis. And then we'll go through some analysis that we complete in related to this. And the next slides, we will go into this area.
Yeah, and as Peter gets ready to present this next phase of our presentation today, I just want to reiterate that, again, no single investment property is going to generate like meaningful financial growth, right? Achieving true results requires a thoughtful plan and really, again, that team to help you build a well-balanced investment portfolio.
And with that, we will go into a specific excuse me. This is a lender overview. So there's different metrics that need to be reviewed, analyzed as you start making a decision on a property. For the lender specifically, they, along with obvious the interest rate, there are some key metrics. For a lender, the property taxes, insurance, if there's any HOA dues, are the primary. Now, this all hinges on the credit worthiness of the borrower. So, similar to buying your own home, you have to go through the entire pre-qualification process. And to also clarify, 1 to 4 units require a conventional loan. Commercial loans, in terms of residential units, are only for 5+ units. So for the 2 to 4 unit markets, you are looking at a conventional loan, which on a high level means that the down payment requirements will be lower than a typical commercial loan. And why that's important is, for those that are just getting into the investing world or have limitations on down payment, then you can still become an investment property owner, but also have the the comfort of knowing that you don't need to come in with such a significant down payment. And along with the metrics, how the lenders review it. So this is just a hypothetical scenario. They, in relation to the property value and how it's appraised, they'll look at the borrower's income. They'll look at the debt that the borrower currently has. There will be some considerations for the income on the property itself. We'll get into the specifics of that at a later time, but if there are tenants in the property and there's historical income generated, that income can be utilized for your pre-qualification review. At the end of the day, the biggest factor is the borrower can't what's the monthly mortgage payment, and if that's in an affordable zone, but also the DTI has to be within reason for a lender to even approve the loan itself. And as a rule of thumb, it has to be below 50%. Now, in the scenario that we outlined for, this is a 3 unit property in Redondo Beach with some estimates already included. The DTI is just over 30%. So in terms of if everything checks off, then for a lender, there will be no concerns in approving this loan. Now we will go to, so we do a few analysis. One would be the income approach, and this is pretty crucial for an investor. So you want to understand, okay, after we determine the income of the property, what are we looking at in terms of expenses? These are expenses that are part of an annual budgeting that needs to be baked into any type of financials. So the high level ones obviously would be property taxes, insurance, property management, and this is just kind of an ongoing repair and maintenance. We'll get into this on the next slide as well, but repairs and maintenance are categorized differently because if you're repairing a property, either updating or any type of capital improvements, those are considered capital expenditures. So, for instance, a lender necessarily doesn't have to factor that in as long as an appraisal value comes in as needed. But for the investor, you'll want to understand the full scope of that. But again, we'll get into the further details of that. But this is a high level of what we look at. And with the current income on this property at the metrics that we included here, your net operating income is right around $56,000. Your net operating income is your gross income minus your expenses. And that becomes a metric utilized to understand your cash flow and if this can be a viable property. So for year one, we're looking at roughly negative 16,000. So That's a pretty significant number, but let's walk through the steps here where that's hopefully it becomes a little bit less shocking. This is the overview projection. So, I mean, any type of investment, right? You're looking at what is my break-even point? Where am I going to actually start making money? So for this specific property, we outlined two scenarios here where if nothing changes and you just do a modest 5% annual increase on rents, this is same tenants, everything runs pretty status quo, then you're between year 4 and 5, you are finally probably going into the positive, and this is strictly on the income basis. Now, we also include a pro forma. This is where you want to understand, okay, these are current rents. What happens when you start achieving market rents for the units that you have? So, hypothetically, if you were able to turn over even two other units of the three and started to get market rents, that improves your timetable to start getting into the positive range between year 2 and 3. And this again is going specifically into just operating as normal. Couple of the things that you also need to take into consideration is that 1 to 4 units properties, they're based on appreciation. So meaning that when the property appreciates or depreciates, that affects the value of the property. That's how lenders view it. That's how investors view it. What it doesn't incorporate is that, and this is probably one of the more crucial things for real estate investing, is again, we're not CPAs, so you definitely want to get a seasoned, reliable CPA. But there are so many tax benefits associated with real estate investing that anybody that even operates a business not related to real estate understands. So some of these tax benefits include depreciation, deductions, interest, repairs, insurance. I mean, there's just a slew of tax benefits that make these numbers basically a bottom line figure. Meaning anytime you have further deductions, I mean, even on your income, you understand the improvements that occurs to your bottom line. So these are some of the factors to keep in mind, but these numbers here, again, specifically associated with the current income and how we evaluate it. And along with the financial income analysis that we do, this is probably one of the more critical ones, and it's the CMA, the comparative market analysis. This is what we do to determine a value and see what price we can target a property at. But also, this is how an appraiser would view for their valuation. So, anyone that's seen an appraisal before, normally, typically, they use maybe 3 to 5 comps. We go a little bit, we do a deeper dive into it just to kind of get a more historical perspective as well. But what we do, and again, this is specifically to that 3-unit property in Redondo Beach, we'll look at all the historical sales. But for a CMA specifically, you should not have to go back more further than a few months. So for this scenario, having this many comps will give us a pretty fair estimate on the valuation and how we can approach a property such as this. Now, one thing to point out here is that more often than not in the 2 to 4, I mean, actually any multi-unit zone, getting the specific unit count may be a bit of a challenge. And this is the same case for an appraiser as well. So you'll see that you'll ask, why are we using duplex comps, 2-unit comps, whereas the subject property is 3 units? Well, what we're trying to derive is understand kind of a per unit and a price per square foot understanding of the sales activity.
Thank you, Peter. So, we've covered, quite a lot of information today for these multi-units in Southern California beach cities. So, again, building a real estate portfolio, you saw, is it going to take me till year 3 to 5 to generate positive cash flow why would I do it? And I think that Peter really brought up the underlying points, right? There's tax benefits, there is appreciation of the property and equity that you have in addition to the cash flow. And as you accumulate properties in your portfolio, you know, you're building upon not just one unit. And I think that's important for, you know, us as a team to support our clients in that journey and where they want to go. So before we move into Q&A, I just want to mention that after the workshop, you'll receive a link to schedule a consultation with Peter and I. This is a chance to really discuss what does your situation look like for you and maybe a client of yours on affordability, and what are the investment options that can be a good fit, right? In addition, we will also be hosting a coffee chat next Thursday from 9:30 to 11:30 here in the San Francisco Bay Area. If you are local, we would love for you to join us and connect in person to really talk about what those next steps would be. So with that said, I'm going to jump into Q&A. Feel free to put your questions in the chat, or we should have you where you should be able to go ahead and speak up your questions. If you cannot, let us know.
Hey, Alina. Hi, Peter. Thanks for the presentation. It's really helpful. I'd like to understand where what is the source of the gross scheduled income? Where does the data come from?
The gross schedule income, this is MLS data. This is basically just the rental income. So they just label it differently, but this is strictly the rental income.
And it's an annual amount?
That's correct.
Okay. Is it provided by the property owner?
The agent. So I mean, it depends, but more often than not, because this is MLS data, the agent obtained this from the owner, landlord, or
Mm-hmm.
maybe even the property manager. And then from that, they will input the annual income, rental income of that data. Now, any review of these properties will involve getting a little bit further backup documentation just to verify that.
Mm.
So, but for the purposes of the slides, when you review it, that is just strictly the annual rental income.
Okay, thank you. I have a second question, if you
Mhm.
don't mind.
No problem.
When you talked about having the rental being at market due to turnover, we know many tenants are in place for a long time, and they're what we call protected tenants. I'm sure you know about it. Can you give us some typical, you know, a case where I buy an investment property, multi-unit, it comes with a long-term tenant. How do and current tenant is paying a lot lower than market rate because they've been there a long time. How do I get the unit to market rate?
Okay. So if I can give you an answer that works, that I should be able to sell for $1 million. There is no easy way. I think anybody that deals with investment rent tenants in general, it's a question that everybody has. Now, to in a broad sense, there's different ways to go about it. Now, you have to keep in mind each jurisdiction, meaning county, city level, there's additional restrictions or requirements. So it really depends on where the property is. Now, you have, even with the statewide rent control, there are things that the tenant can do where it warrants an adjustment, which one of the things that is I mean, available is putting in petitions for exceptions. That involves additional, due diligence and paperwork to do it. Now, when I say this, it's not like if there's a long-term tenant that hypothetically is paying $1,000 and the market rate's 2,500, getting that it's not possible. I mean, unless the tenant leaves.
Mm.
So the simple answer is you have to research for that specific city on what options are available. But more importantly, to get that market rent achieved right away it's really dependent on turnover. So This is where you have to kind of evaluate the properties carefully and individually, is that sometimes you will have long-term tenants that the landlord did the proper thing, did the gradual increases, where even if it's significantly below market rent, it's not as bad. But for a first-time investor or one that doesn't understand the nuances of how to do this process, yeah, it will be a challenge. And more often than not, you probably want to pass on that property.
Mm. Do you think is it quite is it more tough for properties in California than other states?
No, I mean it's a yes, that's a yes and no question too, because it can be, it's a challenge. I mean, California, it has very strict and favorable tenant laws. It's just the way it works. But you can see that maybe you have different states, and we do work, consult in different states as well. So we do have some understandings, but it's not as simple. Well, tenant laws are easier in a different state, so why don't we target that? One of the biggest factors is kind of understanding the local economy. So even if it's a little bit more challenging and tenant favorable with regulations, you can see from a couple of the charts that the baseline averages for rental income in California far exceeds any other state, maybe except kind of the New York, generally
Mm.
speaking, statewide. So going through or understanding that, it really is specific to what the individual investor is looking for. So I can't say that yes or no, since it's going to be easier for a different state, that maybe you should focus there. It's okay to understand the other markets. I think that's very critical. But also, even if you do go into other states, mind you, you can't just look at the high level numbers and say, wow, this has a lot more potential, or the returns look better, because everything, if once you dig into it, it gets a little bit, I mean, nuanced. And I can
Mm.
speak that clearly from a personal experience, where you look at some numbers in different states, it looks really favorable. You enter that position, but at the end of the day, you're gonna have maybe not the same challenges, but there will be challenges that, historically it will offset. So
Mm.
it's favorable to target an area that has a strong tenant pool. That should kind of be your baseline.
Thank you. This is really helpful.
No problem. My
Jane,
pleasure.
thank you, Peter. So we have three more questions that came up in the chat, and I'm just going to read them off. And I also allowed everyone to speak as well. So the question we have is coming from Dan regarding any concerns about crime and homelessness in the area.
Ooh, another question. That's more of a political question, but I will do my best with my understanding. So they are doing quite a bit. Actually, there was a recent LA Times article, ironically enough, specific to Redondo Beach. The city of Redondo Beach has took some of the state funding and city funding, county funding that was received, and created dedicated centers. And I have not validated it, but it was reported that they actually got rid of a lot of people on the streets, because they're kind of guiding them towards these dedicated centers. Now, there's obviously different models being broached into addressing this issue, but that too also goes on a city by city a review that I am not going to. I have my opinions of certain cities, certain beach cities specifically, but within these beach cities, there's also local government that takes a more stringent, proactive approach versus a kind of, we'll let the city or state do what they need to do. So that's usually, it's very city specific as well. It's a problem that has to be understood. I think it's safe to say everybody is seeing a increase, some more significantly than others, but it's understanding local ordinances and regulations.
Thank you, Peter. Dan, did you have any follow-up questions to that response? Okay, we'll go ahead and move on to Zachary's question. How has the insurance crisis affected one's purchasing and costs?
Oh, another great question. Well, insurance costs have gone up across the board in any asset class. California, especially due to the recent fires that we experienced, you have some of these major carriers just leaving the state. I will tell you that beach cities specifically, you're close to the ocean. So that might be a factor that gets incorporated into reviewing and understanding what's covered, what's not covered, how much increase in the premium you can expect because of the close proximity to water. But that is, I mean, generally speaking, so the biggest, I think, other than the carriers that completely left, the primary concern for insurance carriers are fire damage or potential fire damage. Well, the beach cities, we're not dealing with that. The land erosion is always a concern. May or may not have heard Ranchos Palos Verdes, which they don't really have multi-unit properties, so it's not relevant to specifically this conversation. But there's a couple of neighborhoods over there that experience massive landslides. I mean, we're talking upwards of 12 inches a week that it was moving. Last I heard, it slowed down, but for insurance companies, they're evaluating all of this. So there might be additional steps needed to understand the scope of it, but that also is a part of our due diligence to go through hazard disclosures, etc., to understand it. And I mean, and more often than not, actually, for every case, you'll be getting several quotes for insurance, and that's probably a better way of understanding specifics on what type of coverage you're going to get. And if there's any concerns, I mean, you might get a flat out no from a carrier, and then we can understand what's the reasoning, what they're flagging, and either make a decision of should this be concern, or if whether or not we should not even consider a specific location.
Thank you, Peter. Zachary, do you have any follow-up questions? All right. So we did have one more. This is from someone who put in, why are you only evaluating LA County except for Seal Beach in Orange County, and you don't also include San Diego County at all?
Well, the reason for this, we kind of started in this region. Just for the record, I am from LA. We do cover a wide territory. Not, I mean, as mentioned earlier in the presentation, we represent a lot of clientele that does all types of commercial real estate. We did this region specifically just for as an introduction. Our plans with this will be the first of many workshops that we are planning to host in understanding different asset classes, different type of properties, and different regions. Now, to bring San Diego in specifically, we cover a pretty broad territory, all the way down to South County. In terms of 2 to 4 units, South Orange County, you will not have too much of an inventory to choose from. Now, we could obviously review what's available, but the population, the greater population of 2 to 4 unit available inventory is in the Santa Monica down to roughly the Seal Beach. I mean, even if you venture off to Newport, you're not going to see too many multi-unit. You might see some duplexes, but even the 3 to 4 units will go down significantly. Probably you won't rarely see any. So that's the reason. San Diego, we're not necessarily the experts there, and that's the main reason that San Diego wasn't brought in. Now, as far as what I know in San Diego, there are available inventory right in that region, but the reason for the concentration of what we focused on today is our knowledge of the area.
Thank you, Peter. I know I've essentially allowed anyone to speak. So if you have any more questions, I believe we answered everything in today's Q&A chat. Feel free to unmute. All right. Well, if there's no more questions, again, we want to thank you for joining us today. This session will be recorded, so we'll be able to share the recording for yourselves and those folks who have not been able to join us. Again, Peter and I, here's our contact information. You can reach out to us directly, and then we'll also send you a link to schedule some time to talk further. Great. Thank you so much,
Great.
everyone.
Thank you, everyone.